What is short selling? First of all, we'd just like to point out that we are by no means experts, but we'll have a go at describing what short selling is in the simplest terms, and then later on in another video we'll discuss how to short sell within the Tycoon market game. A short sale is like a kind of bet that a stock will go down. So, in our example, we'll use a fake company name, let's say ABC, and we'll pretend ABC stock is currently trading at $100. I come along and I've done loads of research and analysis, and I'm convinced that things will start to go bad for ABC and that the stock is going to go down. I think it's going to fall to $50. So I call my brokerage. This is my broker. This is me here, nice curly hair. So I go to the broker and say, "Broker, I would like to short ABC. For simplicity, we'll just short one share of ABC." So I go to the broker to borrow a share. I know that sounds a little weird, but bear with me. You could also view it as renting a share. So where does the broker get it from? Well, this broker has a ton of clients, many of whom own shares in ABC, and they keep their shares of ABC with the broker. If ABC ever issues a dividend, each of these shareholders of the company will get, say, $5. So each of these guys gets a $5 dividend. And just so you know, as opposed to going short, these guys are going long. When you are going long on a security, you are buying the security and betting the value will go up. When you go short, as you'll see, you are borrowing the security and then selling it, hoping that the value will go down. So let's see how that works. I go along to my broker and say I want to borrow a share of ABC. So the broker goes, "Okay, I have all of these shares sitting around and they're really not doing anything. I'll lend you this share right here. Stick it in my account and I'm going to have to pay a fee. Sort of rent to borrow that share. You could view it as interest on borrowing the share, a fee, or rent. Viewing it as rent is a little more intuitive. When you say rent someone's apartment, you're really borrowing their apartment. Anyway, I think you get the idea. So I'm borrowing this, and you might say, hang on, that doesn't make sense. How can you just borrow that guy's share? I mean, this guy might want to sell it the next day, and that's a good question. So let's say I borrow this guy's stock, so it's not sitting there anymore. If this guy wants to sell his stock a few minutes after I've borrowed it, the broker is just going to shuffle around the stock a bit. Stocks are what's sometimes referred to as fungible. You can replace one stock certificate with another, they're no different. So then he'll just say, "Okay, I'll give this stock to that guy that wants to sell it," and then you would have essentially borrowed it from this guy. The broker can just keep rearranging the shares, and none of these guys know that their stock is borrowed, although they would have previously given the broker permission to let the stock be borrowed, and they benefit by getting a cut of some of the interest or rent that the short seller is paying, so it's beneficial to them. The broker should never lend out all the shares so that he can keep shuffling them around. So, getting back to the share I have borrowed off this guy. Now, what happens when ABC issue a dividend? Each one of these shareholders should get $5, and this guy is expecting a $5 check or $5 deposited into his brokerage account. For that to happen, I essentially have to give this guy $5. The broker has to make it look like this guy still has his ABC share, so they will take $5 off me and give it to him. So anything that this guy gets or is expecting, I have to provide that for him. Anyway, so I borrowed the stock. Now what do I do with it? So my whole thesis here is that this stock is going to go down to $50. So how do I make money off that? So I borrow one share and I sell it on the market straight away for the current market value, which in this case is $100. I'm selling it even though I don't own it. So let's take a look at what's going on here. What are my assets and what are my liabilities? What do I have and what do I owe? So now I have $100 and I owe one share of ABC. Let's say my analysis ends up being correct and a couple of days later ABC shares goes down and starts trading at $50. What I can do now is unwind my trade or cover my short. And the way I do this is I have my $100, so I can just go out there and buy a share of ABC back. But the shares now only cost $50 to buy, so I pay $50 and I get back a share of ABC, and that's what I owe, so I can give it back to the broker. So in the process, I made $50. I borrowed a share when it was worth $100, sold the share for $100, therefore I had $100 in my pocket, but owed an ABC share to the broker. When the stock went down, I bought a share at $50 out of the $100 I had and gave the share back to the broker. I therefore no longer owed an ABC share to the broker, and I had $50 in my pocket, which was my profit. So, now my assets are $50 and I no longer owe a share, so I have no liabilities. Although, don't forget, I had to pay fees to the broker, say $5, and a dividend payment, say another $5. So at the end of the process, I made $40. So traditionally on the stock market, on the long side, you want to buy low and sell high. When you're going short, you're doing it more or less in reverse. You want to sell high and buy low. Of course, it could all go horribly wrong. If I borrowed a share at $100 and sold it for $100, and then the price of the stock went up to, say, $200, I'd be minus $100 plus fees. Short selling is much more riskier than going long. The potential losses can be infinite. The worst case scenario, going long, i.e. the share price is going down, is that the maximum you could actually lose is the price you paid for the shares. It stops at zero and it's your money, that you paid up front that you were losing. However, the worst case scenario in going short, i.e. the share prices goes up, is that it can go up infinitely, so your losses could be infinite and you actually owe someone that money. If you have shorted and the price of shares are going up, there are three main things that can happen. 1. You chicken out. You buy back the shares you owe at the higher price and cover your short position, so you'll have lost money. 2. Sit tight and hope that they come back down and go lower than what you sold them at. Or 3. The broker forces you to close your position and you will have most likely lost money. When you want to open a short position through your broker, you'll have what is called a margin account, sometimes called a brokerage account. This reassures the broker that you are able to cover your debts, up to a certain point anyway. I hope that goes some way to explaining short selling. Please watch our next video explaining how short selling works in Tycoon market. Thank you.